Good afternoon, everyone. Great. Starting class, 6 o'clock. We got 15 minutes of current events. Question number 1. It was 10-year treasury today.
I know what
I know what it was this morning.
What was it this morning?
2.32.
it
Yeah, it was 235, like when I last checked in the middle of the day. Is that higher or lower than last week?
Lower.
Isn't the Fed saying that they're raising rates? 2 more rounds? What's going on? What's going on?
Still gonna take a while.
Well, but if the Fed's raising, I mean, it goes back to the slide I said the other day. I'm not sure whether the Fed leads or follows, okay? And that's issue number 1. And again, whether their target rate is something that can really be that controlled or whether the market really. So they're a large player. They're a large player, but they, you know, they're not the only players out there. And curiously, talking about that, the question was asked the other day, or the topic was brought up the other day. We were talking about whether we had a flat yield curve today or not. And there was an article I pulled out the other day, and it said, you know where this was? Where was this thing? It was on the Wall Street Journal. It says flatter yield curve in 2017 shows growth concerns are lingering. So in fact, I mean, other people have identified that we've got a flat yield curve. Now, I didn't have the time. I started playing around with it. I said, well, let me go back. So I pulled like stuff out. I went to Fred. Fred, what's Fred?
Yeah,
Fred?
Federal Reserve of St. Louis.
St. Louis. So pulled out like the interest rate, you know, on the yields of maturity on like 1-year treasuries, and I had like 10-year, but then there was like a bunch of years missing, and I just didn't have time. And I think it's a much more, you can't just do this quick and dirty. You kind of got to take a look at really on the short end, the 30-day, 90-day, compare it to 10, maybe take 1 and compare it to 30. And pick some periods of relative, you know, economic stability to get some sort of baseline. But what this article brought up, which was very interesting, it basically said that they were talking about it. So they were looking at a spread between 2-year and 10-year, and they, you know, basically said that has really narrowed. You know, when you look at the problem is they've got a chart here for 1.5 years, so it's not really that telling, okay. When you look on, there's only 1.13 percentage points. So whatever, 100 and whatever basis points spread between the 10 and the 2. So they're saying it's relatively flat. What's more concerning, I think, it's not concerning, it's something to keep in mind. They took a look at the gap. Remember the other day I talked about the relationship that exists between high yield and risk-free, right? And when you had a narrowing gap, it talked of economic prosperity. When you had a widening gap, it talked about uncertainty, right? And at the beginning of 2016, there were 8 percentage points difference between the high yield and the treasury. And that compressed down to slightly over 3.5% at the beginning of the year, which really talks to like a lot of I think a lack of prudence on the risk that people are willing to assume and a return that they expect in return for that, right? So you're saying, hey, for an extra 3 percentage points. Daniel, you going to join us today, or?
Yep, just putting on my notes.
Okay, thank you.
Well, there was an article that makes an analogy about liquidity of the bond and some S&P 500.
Well, so right, so that, I mean, so the relationship that people talk about is what's the dividend yield on the S&P 500,
Right.
and what's
The T-bill.
what's the 10-year, you know, sort of like midlife to midlife assets.
And right now,
And
the T-bill is so close that it makes more sense just to stay with the T-bill.
Well, I don't know. I think some other people are saying something different than that. They're saying the T-bill, the Treasury notes are paying No, the 10-year treasury notes are paying 2.35%, we just said, if you hold them to maturity. They're paying 2.3%, and the dividend yield on the S&P, I don't know what it is, but it's over that. It's 2.7, 2.8. People are saying, hey, if that's just dividend, you know, maybe we need to put some money over there, okay? Now, that said, yields have been coming down. It means people have been buying treasuries for some reason. So, yeah, listen, you can't just look at one day, and you can't just look at 1 week. But I think there's, you know, this like, you know, those bears that are fighting all, you know, like there's the good bear and the bad bear, or the good wolf and the bad wolf. You know that legend? It's kind of like I forget how it goes, but the grandfather was telling the kid about the good wolf and the bad wolf, and well, I forget how the story goes, but the kid at the end goes, well, Grandpa, which wolf wins? Does the good wolf win or the bad wolf? And he says, the one you feed. Okay, so I don't know which one's going to win here. It depends what we feed, okay? But going from 8 percentage point spread down to 3.81 today, so it had gone down to 3.5. That seems like it's going back up. It's still just barely moved, but 3%, wow, that's scary. So anyway, just stuff to keep your eye on, that kind of stuff. Another one that I thought was interesting was first calendar quarter of the year ended on Friday, Saturday, something like that. The S&P 500, how did it move? Do we know? Did it go up? Did it go down in the first quarter?
Up.
How much?
Not exact percent, but I think about 2% or so.
2%?
Roughly.
Andre, come on, say something, dude. I need you to say something.
2.4.
I need to say
3%.
3%?
2.4, I think.
2.4, 3. Daniel, what do you say?
I'm saying 3.5, 4.
Chris?
We lie if I gave you that.
5.9%, 6% and a quarter. So stop to think of this. We're in an economic growth environment of, GDP's growing, what, 2%? And the S&P 500, so the broad index of the market went up 6% and a quarter. Annualize that, what do you get? 24%. Is that sustainable? How does that come about? We talked the other day about price earnings ratios, right? We talked about price over earnings. Now, what did we say that was the converse of what? It was like cap rates, right?
Right.
It's kind of like cap rates, right? So it's the inverse of cap rate if you look at it that way. But the only way that you can get a 24% appreciation or a 6% quarterly appreciation in your broad index is what? If this goes way up in comparison to this, because earnings can't be growing 24% in a 2% environment. So, I mean, this talks to what I said the other day of the S&P trading at 22 times trailing earnings. And it also talks to, I think it was your question the other day about whether it made sense to own real estate privately or publicly. Well, it depends how the market values it. And there's times when the market values public equity. We'll see something later today where the market values public equities, you know, in a more dear or expensive fashion than they value private, you know, equity. So, just food for thought. Staples this morning announced, or it leaked out that Staples was talking to
Buyout firms.
private equity firms, because at the end of the day, that was one of the stocks I had in my holdings. I just sold it, okay? But basically, it was a deep value play, company trading like at book value or something like that, you know, a lot of liquidity. No, management is sitting there saying, okay, we understand we have a rough environment, but it's a pretty creative and innovative company, and they're going to survive, and the public's just not valuing, and they're saying, hey, we could probably entice somebody to help us buy it. We'll pay a premium to what the market's paying, but we'll still be able to work without the pressure of every quarter, and we'll be able to resell this sometime in the future.
Just you might running this scenario again. The price per the PE ratio.
price per share.
Yeah, price over,
So,
earnings
so
per
like,
share.
let's take a look at one that, well, let's just make one up. A company has $1 of earnings per share. So, it made $10,000 and there's 10,000 shares outstanding, okay? Now, it can be more complex than that because you get into primary and secondary or diluted, fully diluted, and you start getting into common stock equivalents and all that. Let's just assume it's a very straightforward capital structure. The company made $10,000 in net income, it has 10,000 shares outstanding. It made $1 of earnings for every share that was outstanding, okay? It's trading at $20 a share in the marketplace. So its price earnings ratio is 20 over 1 equals 20x, okay? If it's trading at $10 a share, its price earnings ratio is 10x. The cap rate, the inverse of that would be 10%, 1 over 10. And again, I keep saying it, cap rate is NOI over value. This is earnings per share over price per share, which is not exactly the same thing, but it's a close enough proxy, okay?
Okay, but you made a comparison against the 24% potential,
Now, all I said was that the S&P
24.
went up 5.9% in 1 quarter. If you multiply that by 4, you get a 24% increase, annual, assuming if you annualize that, right? Now I'm saying earnings didn't grow 6% in 1 quarter to justify that. So if the denominator didn't go up, the numerator went up. Why? Expectations of growth, pulling money out of, debt markets, whatever, people bringing money from other countries, who knows? Or a combination of all of those. Does that answer the question?
Yeah.
Okay. Listen, I rarely tell people to go to things. And I'm not going to tell you to go. I'm going to leave this here. It was in a Business Monday yesterday. The Greater Miami Chamber of Commerce, they have these annual things every now and then, but they've got a presentation on Friday, April 21st from 7:30 to 1:30 at Jungle Island. The morning keynote is my old boss, Mr. Cadena. He should give a good talk. The lunch keynote speaker is Ed Easton, who's a good friend, who's another developer. He'll probably give an interesting talk as well. You got some important people that, in the commercial real estate industry in South Florida. Jack Lowell, who's been like the dean, he's probably the dean of brokers right now, commercial brokers. Jose Gonzalez is an old colleague who is, it's all about, his whole thing is regulation, entitlements, processing things. Stuart Wiley, who runs the Graham companies that develop Miami Lakes. I mean, these are all, the guy that runs, I don't know him, but the guy that runs Swire Properties, which just built Brickell City Center. These guys are all talking.
When is that?
And I'll leave it here, Friday the 21st. So, I mean, it costs money, so that's the only problem, but figure it out. And then they got other things. There's some nice brokers here that, give you some insight on the industry. I might go. I don't usually go to those things. Charles, did you know that we're doing the Wall Street Journal assessments?
Yes, sir.
Did you know that you have not done them?
That shouldn't be the case.
Okay, well, you need to take a look at that, okay?
I will.
All right, listen, it's 6:15, so those of you who came early understand we need to leave now. I can't force you to go. There's a talk in the Hudson Center on the 3rd floor. I need to go. I've been encouraged to bring my class, so I encourage you to come. I don't know what the guy's name is, Steve Hallman, Holmes, something like that. He's a trustee of the university. He's an entrepreneur. He built like a big company called Safeguard or something like that. He sold it. He's going to give a talk. I think he's a real estate investor. It's a 1-hour talk. We need to go up now. We'll be back at 7:30 because I won't be able to tell you anything up there. Thing ends at 7:30. I'm going to start class in here again at 7:45. We got to finish the textbook material, okay? and then we'll go to do other things. So I need to go. I'm encouraging you to go. Can't force you to go, but I would encourage you, to go. So that's all I can say. So I hope you follow me. And I know Angelo's injured. He's battle scarred, so he's going to stay. But
I got a rental.
I think we need to go.
You said you're there before?
We're trying to. It's on the third floor, Hudson Institute.
Okay.
You have Professor.
Thursday night?
Yeah, I can.
Everybody didn't go?
Yeah, really.
And then I had to go to his house the other day.
No.
So I stand outside.
Well, I was pissed about that.
Oh, it's
Yeah, do you need
optional.
a message or something?
But I'm gonna
Yeah,
go.
Thursday morning.
Might as well.
What else
are we gonna do right now?
Stepped out of my way.
You have any?
I started walking on my street,
Yeah.
which is on the side.
Oh, that's really funny. I mean,
But I wasn't even planning on it, I just thought about it, like, how am I gonna
I
be
have my local market book in my back. I want to him too. That's
But he had happened to buy, so I thought.
Oh, he bought? Oh,
Cause I
But
do
he always
people
wearing
like-
jackets with my elbows in.
yeah.
You're okay.
Yeah, no,
first couple days
I would
there,
say I don't
man,
see him that often, but I can certainly, I probably will see him on Saturday when we have class together.
Are
Oh,
you?
you do have class.
I'm okay.
I just realized Saturday, yeah, I'll see him.
I was waiting,
Ethics?
Did you break your butt?
Real estate law and ethics.
Yeah, ran over a car.
But they didn't have to put,
Oh,
Yeah,
I was like, I was
so
late.
you-
He turned in jeans. I was like,
no, they didn't have to put a cast because my bone was broken, like perfectly,
Oh, okay.
position. So they said that, just gotta work, use crutches, take it easy, and they'll put the weight. Is that thing on or?
It's on. Now you turn it off.
It's off, right?
No, it's on.